Great.
Hello friends, a very good day to all, and I hope all of you are doing very fine. Over the next few minutes, we are going to discuss about the key events that have happened in the last fortnight related to the Indian equity markets, and we'll also give you the overall market outlook. So to start with some global backdrop, the biggest development that has taken place in this week is the US Federal Bank hiking the rates by 75 basis points, and this was the third consecutive time they have hiked the rates by 75 basis points. So with the latest rate hikes, they have raised by a total of 3 percentage points in the last 6 months, and this has been the tightest tightening cycle ever. So the US Central Bank is slamming the brakes in a very hard way to control the inflation, even though it recognizes this will slow down the economy this year and even in the next year of 2023. The US Federal Bank has also pledged to remain hawkish to curb the inflation and to take high interest rates as high as 4.6% in 2023. It has also indicated there won't be any rate cuts in 2023, which the markets were earlier expecting, and the first rate cut probably will start in 2024. The Fed has given a clear indication it will remain higher, interest rates will remain higher for longer. Indian equity markets have remained under pressure in tandem with the global markets post the aggressive rate hike by the US Federal Bank. The US 10-year, which is a key monitor by the global markets, has touched 3.71. It's the highest level it has touched since 2011. It's a 11-year high. Also, the dollar index has touched a fresh 20-year high, and it is trading around 112 currently. The one positive for Indian markets is the Brent crude oil prices has come down to $90, and it has come down by 25 to 30% from this year's high, which was around $125 to $130. Among other major central banks, Bank of England also raised the rates by 50 basis points yesterday, its 7th consecutive hike, and it has taken the policy rates to 2.25, which is the highest in 14 years. Surging inflation resulting in aggressive tightening by global central banks, leading to fears of economic slowdown and geopolitical tensions between Russia and Ukraine are the key concerns the markets will be monitoring for in the near term to the medium term. Despite so many global headwinds, Indian equity markets have stayed resilient and have stood tall in the challenging environment. Indian equity markets, just to give some backdrop, in the current calendar year, Indian equity markets have remained flat, and whereas the major other global markets like US S&P 500, Nasdaq, German market, French market are down by anywhere between 15 to 25%. The outperformance of Indian equity markets reflects the overall faith global institutional investors have in the Indian domestic growth outlook and in the corporate earnings outlook as well. India remains the fastest growing major economy in the world, and the corporate earnings in the last 2 years in the absolute terms have grown by 65%. In fact, the corporate earnings are expected to grow at high teen levels for the coming 5 years. So we expect the current volatility to continue due to the various factors discussed in this video, and investors to take advantage of this volatility and build long-term portfolios with high conviction stocks and to build a solid portfolio by using this volatility.